everyone, welcome back to Mindful Investing. Sprouts Farmers Market, ticker symbol SFM, just had a brutal week. The stock plunged almost 26% right after earnings, and year to date, it's now down roughly 35%. Naturally, a lot of investors are wondering what happened? How did a company that seemed to be just doing fine on the surface end up losing a quarter of its value in just a few days? Well, in this video, we'll break down exactly what went wrong in that Q3 earnings report, what triggered the sell off, what the key risks and opportunities look like going forward, and finally, whether I think SFM is a buy or not at these levels. So, let's dive right in. Let's start with the numbers first because that's where the story begins. In the third quarter of 2025, Sprouts reported revenue of $2.2 billion, which was up about 13% from the same quarter last year. That's a solid growth for a grocery retailer. But here's the catch: analysts were expecting roughly $2.225 billion, so it came in just a bit light on the top line. Now, if you look at the earnings, the things actually looked quite good. Earnings per share came in at $1.22, up from 91 cents a year ago. That's a 34% increase, showing that profitability continues to improve. So, if you're just skimming the headline numbers, it's not a bad quarter. But the real issue wasn't what Sprouts reported, it was what they said about the future. Management guided for comparable store sales growth of just 0% to 2% next quarter, down sharply from 5.9% in Q3. They also forecast Q4 earnings per share between 86 cents and 90 cents, which was well below what Wall Street was expecting. That one statement, growth is slowing, was enough to send the stock spiraling. Because when you're priced for strong, steady expansion, even a small hint of deceleration can lead to a major sell off. Let's also take a closer look at Sprout's financial strength because even when sentiment turns negative, the balance sheet often tells a different story. As of the end of Q3 2025, Sprouts Farmers Market had $322 million in cash and cash equivalents and no outstanding borrowings under its $600 million revolving credit facility. That's an excellent liquidity position. It gives them flexibility, and more importantly, it shows they are not over leveraged in a high rate environment like this. On the debt side, their long term debt is around $250 million, which is actually quite modest compared to their size and cash flow generation. And speaking of cash flow, over the last 12 months, Sprouts generated roughly $490 million in free cash flow. That's more than enough to fund new store openings, ongoing operations, and even share repurchases without having to tap into debt or issue new equity. So, financially, SFM is in a very solid shape. They are profitable, self funded, and operating from a position of strength. And honestly, in the mid cap retail space, that's not something you see very often, especially in a market where many retailers are still juggling debt from the last few years. Now, despite all the noise around the earnings miss, there's a lot that's actually going right now for Sprouts. For starters, revenue is still growing at a double digit rate year over year. That's not the kind of trend you see in a business that's supposedly struggling. In Q3, they opened 9 new stores, bringing their total footprint to 464 stores across 24 states. And management plans to keep expanding steadily through 2026. Their store model remains one of the company's biggest strengths. Sprouts focuses on health conscious, organic, and specialty foods, targeting a customer base that values quality and wellness over price. That niche positioning has helped them build strong brand loyalty even as big box grocers like Walmart and Costco try to compete in the organic space. Margins also tell a good story. Gross margins held firm around 37.1%. Operating margins improved slightly to about 7.3%. That means they are maintaining pricing power and cost discipline even in a competitive environment. On top of that, Sprouts continues to generate strong returns on invested capital and heavy free cash flow, giving management flexibility to reinvest in growth or buy back shares when the stock looks undervalued. So, from a fundamental perspective, this is still a high quality business, well run, financially healthy, and structurally profitable. So, with all that good news, you might be wondering why on earth did the stock still drop 26%? Here's the real story, and it's a mix of fundamentals, expectations, and sentiment all colliding at once. Number one is the big one, which is the guidance shock. Investors were expecting Sprouts to keep posting strong, high single digit growth, but when management guided for flat to 2% comparable store sales next quarter, that was a clear signal that momentum is cooling. In the market that had priced in continued acceleration, that comment alone was enough to hit the brakes. Second, we are dealing with tough comparisons. The last few quarters benefited from record demand and strong margin expansion. Now, with inflation easing and consumer spending normalizing, shoppers are starting to pull back a bit, especially on premium and organic items. So, naturally, the year over year growth comparisons are getting harder. Third, sentiment turned sharply once the analysts weighed in. Big firms like Barclays and Goldman Sachs cut their price targets after the report, citing slower growth and tighter consumer spending trends. And when that happens, momentum traders and algorithms usually follow, amplifying the downside move. In short, this drop wasn't just about disappointing numbers, it was the market finally catching up to reality. A combination of stretched expectations, cooling growth, and a sentiment reset. Now we have to zoom out and look at the bigger picture as well. The grocery and organic retail sector is facing some serious headwinds right now. Competition is intensifying. Traditional players like Kroger and Costco are expanding their organic selections, while Walmart continues to push deeper into natural and fresh food categories at lower prices. That puts pressure directly on Sprouts. Sprouts built its brand around being the go to store for health conscious and organic shoppers. But now that same customer can find similar products at bigger chains, often for less. That means Sprouts has to keep evolving, innovating around pricing, private label products, and digital engagement to maintain its edge. Now, let's flip the script because there's another side to this story that deserves attention. Despite the short term pain, Sprouts Farmers Market still has a lot going for it. A clean balance sheet with virtually no debt, consistent free cash flow generation, nearly $500 million a year, a scalable business model that still has room to grow in underpenetrated regions across the US, strong profitability, and disciplined capital allocation. Management has been careful with costs and strategic in expansion, and a powerful brand position in the health, wellness, and organic grocery space, which continues to grow faster than traditional food retail over the long term. In other words, the fundamentals haven't broken, the narrative just cooled off. Several analysts, including those on Seeking Alpha and Tip Ranks, have already called this sell off an overreaction, noting that long term investors could use this as an opportunity to accumulate shares at more reasonable valuations. And honestly, that's how great investments start when strong companies go through temporary turbulence and the market focuses too much on the short term noise. Alright, so the big question is Sprouts Farmers Market a buy after this 26% drop? Here's my honest take. If you are a long term investor who believes in the continued growth of the organic grocery space and in Sprouts' ability to keep expanding, then yes, this pullback looks like a very interesting opportunity. But if you are a short term trader chasing momentum, you might want to stay patient for now. The technical setup still needs time to rebuild. Sentiment is weak, and the next quarter's results will be key in showing whether this slowdown is temporary or something more structural. That said, from a technical perspective, the stock is now trading below its 200-day EMA on both the daily and weekly charts. Historically, for quality names like this, that's often where long term investors begin accumulating, and personally, I see this as a great entry point. So, here's what I'm doing. I'm starting a small position right here and will scale in gradually if the price continues to consolidate. I'm also adding SFM to my stock prediction spreadsheet where I track all the stocks I've covered, my price targets, and my actual returns. You can access that spreadsheet yourself. I've linked it in the description below. So that's my complete breakdown of why Sprouts Farmers Market dropped 26%, what's really happening behind the numbers, and how I'm looking at the current risk reward setup. Now, I'd love to hear your thoughts. Do you think this sell off was justified, or is the market overreacting to short term noise? Drop your opinions in the comments below. I always enjoy reading your perspectives and learning from them. If you found this analysis helpful, please like the video and subscribe to the channel for more stock deep dives and long-term investing insights. Until next time, stay patient, stay rational, and keep investing.